Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd and on podcasts everywhere. And today, welcome, in fact, today to the Real Estate Reality Show weekly news roundup with my good friend, Dave Saxe of Calvera Partners. And this week, we are going to be talking about three topics from the last few days of news. Of course, cannot get away today without talking about the latest Federal Reserve announcement this morning, or commentary from Jackson Hole. So we'll talk about that briefly. Our second topic today are the new SEC regulatory changes on private equity. Oh my goodness. Some big impacts there potentially for real estate. And then the third thing, try as we might, Dave and I are unable to avoid the topic of the multifamily roller coaster. So we'll talk about that as well. But let's start off. Here's what I'm going to try and do today. A little bit different. I was telling Dave that I actually listened to the BBC BBC Radio 4, being a die-hard Englishman. I like to listen to that. And they have a Today show, and every morning they go through some of the latest news headlines. I really like that. So I thought, all right, maybe we can do that today. So we're going to try and do that on steroids. And then we're also going to comment on what we're seeing here. So the first article that came out. So this is, what are we? Friday, the 25th of August. Fed's Chairman Powell made some comments at Jackson Hole today. So this is what he says. Reuters headline today: Fed's Powell says higher rates may be needed. We'll move carefully. I'm going to read a brief quote here. Hopefully it's not too much of these quotes. But anyway, this is what he says. Federal Reserve may need to raise interest rates further to ensure inflation is contained. Fed Chair Jerome Powell said on Friday, nodding both to the easing price pressures and the surprising overperformance of the U.S. economy, and promising to proceed carefully at upcoming meetings. Now, he's not yet concluding that the benchmark interest rate is high enough to be sure that inflation will return to its 2% target. We are prepared to raise rates further if appropriate, and intend to hold policy at restrictive level until we are confident that inflation is moving sustainably down towards our objective. Dave, impact on commercial real estate. What does this tell us?
No bueno.
Exactly right.
My first reaction to that, and I'm thinking of some comments Barry Sternlicht has been making too before this comment about what they're doing to the real estate market. I mean, values have already fallen 20 to 25%. It's just a math game. If interest rates keep going up, it's more expensive to get a loan. That means that you can't juice your returns as much in your financial models for acquiring commercial real estate. So you're going to have to pay less to get whatever return that you want. So my conclusion to that would be is if interest rates continue to go up, that will lead to further declines in values, which have been all over the news.
Exactly. And then the Associated Press news. So these are, you kind of get a sense. I do try and read articles from either the commercial real estate, which are apolitical, or from general news sources that are hopefully down the middle. AP News tends to be ever so slightly left. Reuters is straight down the middle. But so here's the AP News headline as well. Economies' solid growth could require additional Fed hikes to fight inflation. Here's their observation just in the last hour or so. Powell noted that the economy has been growing faster than expected and that consumers have kept spending briskly, trends that could keep inflation pressures high. He also reiterated the Fed's determination to keep its benchmark rate elevated until price increases are reduced to the central bank's 2% target. Now, what's interesting about that is that I do see on LinkedIn, hey, you know, all these commentators like, hey, inflation is down. Why are we still doing this? Well, the point is that, yeah, it might be down, but it's a bit like kind of pushing your hands down on something that's trying to spring back, right? If the economy is still humming along at the same kind of pace that it is, super low unemployment, people traveling, spending, It's just a solid foundation for economic activity. That is inflationary, right? And that's the whole point, that has to be kept under control, and he's not seeing that yet.
Yeah, absolutely. I mean, there's a backlog. Also, yeah, as you said, everybody I know is traveling, spending money again. They weren't able to do that for so long. I've also been reading the debates on, is 2% the right number? Should it really be 3% now?
Right.
And
I
I don't
always
know
wonder
how
when
many.
I see that, should it be 3%? Or what about 4%?
Well, my reaction was going to be, yeah, those are folks that don't want interest rates to keep going up for the reasons, particularly in real estate, for the reasons that we've talked about. So I'm an economics major, so I only know 2%.
2%. All right. So why is it 2% as the target, by the way?
Ah, man, you're bringing me back a long ways. I think that's what evens out supply and demand in the labor market, I believe.
Okay. All right. So then here's another one that's article directly related to commercial real estate. And this comes from investmentnews.com. Their headline: it's time to start looking at private real estate again. This is an interesting journal that I found here. And this is what they say: while the current market appears uncertain and complex, the intricacies of real estate investing do not necessarily spell trouble. Complexity often deters less sophisticated investors, leaving opportunities for skilled managers to achieve attractive returns. This is exactly what we're talking about in terms of opportunities. One more point here: scarcity of available financing in real estate, this is a continuing quote, may yield opportunities for private funds that possess scale, established presences, and a wide range of capital and financing options. In short, cash is king.
Yeah, no, we're seeing we've been seeing that increasingly. I just got a call this morning about a distressed apartment portfolio where they're looking for preferred equity at an attractive rate to kind of fill that gap and to carry them on a little bit longer to see if they can wait out the recovery. So we're seeing that. Yeah, cash is king. I mean, for the deals that we're looking at in the multifamily space, you just can't get the same loan proceeds that you could anymore. So you have to cut much larger checks in order to acquire the property. And then as interest rates, as we just talked about, continue to move, just trying to get a sense of where your loan's going to come in and your interest rate makes it very challenging to do any sort of financial modeling and figure out where that bid-ask spread is going to finally meet in the middle. It's very complex out there. So if you could do something all cash, you're removing that huge risk, I'd say, or uncertainty.
Well, this is the point that Investment News really levers off, and that is it's sophisticated players. Really, this is a time for sophisticated players, right? Newbies are not going to win in this market. They continue. Go ahead. You were going to say something, Dave.
Well, yeah, you got me excited there because with your institutional background, my institutional background, I think we've talked about this in a different context, is when there's downturns like this, it's going to shake out some of the players that were riding off of the free, easy money. And because of the complexity of some of the distress that's out there, having experience navigating the different types of capital you can provide, the different structures, various different different folks in the capital stack. This is where you're right. You need to know what you're doing.
Well, this is what this is exactly that point from Investment News. This is their perspective. There's general agreement among leading alternative investment providers, right, in which, of course, real estate falls, that it is wise to refrain from attempting to time the market. As research suggests, it is challenging and can lead to poor investment decisions. Instead, the key is to focus on timing in terms of valuation, margin of safety, and potential upside. In the case of real estate, these factors excite us about the current opportunity. Not easy to do. This is not a rising tide. To succeed in this market requires deep experience and understanding of true market fundamentals.
I like the point too about the market timing. Sure, we all know values are down 20 to 25%. Maybe they're heading lower here with increases in interest rates again. But, as I've worked in large institutions in the real estate side, when we're actually in an environment like this, the phrase is trying to catch a falling knife.
Mm-hmm.
And where do you go in? And it's really hard to make that psychological decision to actually move in. So all of those points in the article are so true, and knowing what you're doing, having experience, and identifying and trying to mitigate as many risks and downside as possible is so important.
Topic number 2. This is a really interesting one. SEC regulatory changes on private equity. So here's a couple of articles and a couple of quotes. Financial Times, their headline was "Private Fund Industry Prepares for Battle Over Sweeping US Rules." And I quote from the article as follows: "The global private funds industry is bracing," global actually, but of course we're talking about US, "for one of the most sweeping regulatory reforms in its history, as the US Securities and Exchange Commission prepares to impose tough rules on private equity, real estate, and hedge funds. The new rules are geared to, quote, prohibiting secret side deals that give better terms to some investors and limiting what expenses private managers can pass on to their clients." And we'll continue with one other quote before asking your view on this, Dave, from Mark Roderick, our friend over there, crowdfunding attorney. He actually puts out this really interesting blog. It's worth signing up for. SEC adopts final rules for private advisors and stresses fiduciary obligations. And here's what he says: "An advisor can't give other preferential economic rights to some investors without full disclosure to all investors. Preferential treatment is allowed with full disclosure: 1, before the investor invests; 2, when the fundraising period has ended; and 3, annually." Oh my goodness. Impact on commercial real estate. Dave, give it to us straight.
Oh man, I was been spending the last couple of days reading about this as someone with a private fund, and wow, I mean the amount of overhaul here was what really caught my attention. This isn't one little change. Mm-hmm. This is a lot of work on the compliance side, on the legal document side. This is huge. One distinction I'll make, though, is that from what I can tell, the SEC has made a distinction between companies or funds that are registered, yes, and funds that are not. So when you get really big and to attract large institutional investors, you have to register. So for example, a lot of funds are not. Like ours, we're small enough where we're not registering. That being said, we often act like we're registered so that if we want to attract that money, it'll be there. But one distinction to make is a couple of the rules were just for unregistered and everything else applied to all the registered firms. So a couple things. Side letters are so common. Right. In the industry. They've happened forever.
And their side letters are not disclosed to all investors. They are side agreements.
All over the legal documents that we've always done, that with really good attorneys, it specifically says in the risk factors at the end of our private placement memorandum that side letters are not disclosed. This is a complete shift. And
it's retroactive, isn't it?
Okay, so I've been digging into that, and it's a little bit unclear. So they have some rules in there about the size of the firm or the fund, whether or not it's registered, and each of these individual things that they've done, and we didn't even get into the other 4 or 5. They have different compliance periods, and I actually have an email into my attorney right now as we speak about whether or not it's backwards looking. I'm not sure that it is, because that would be massively impossible to handle.
Well, now you got to send letters to all your investors saying, by the way, we have a group of investors that have significantly better terms than you did, that we solicited at the same time as we were soliciting from you. That's not trivial.
Right. And one other quick thing is, one of the things too they specifically called out was for open-ended funds. So your B-REITs and other things like that, those are all over the news over the last number of months with a flurry of redemptions. And oftentimes these things have what's called lockout periods, where you can't redeem your share for a certain amount of years after you make the investment, which is totally normal and fine. But these new rules state that you can't have preferential redemption terms for investors unless that's fully disclosed. I mean, we're just covering two of the many things that were in here. This is a massive, massive change.
And the timing couldn't be worse. His
yeah,
right?
If you're trying to attract capital, you've got distress out there. There's a lot of uncertainty. So yes, there's also things about auditing in there, requirements of auditing, quarterly reporting, things like that people were normally doing anyway. But when I read this, I was like, wow, just seeing one of these changes would have been impactful, but there is 5 or 6 of them. It's quite intense.
Right. Okay. So we'll have to see how this thing rolls out. Now, these are finalized, right? These are final rules. This is right.
I mean, yeah. Now, this always gets confusing. I've talked to my attorneys about this when other rules have come out, and they get tied up in different legislations, and sometimes it gets really confusing about whether or not it's guidance versus actual rules, how they're enforced. It's very confusing. This looked final to me.
Yes. Well, in Mark's blog, he actually had 2 columns, and he went through a bunch of the different changes. But one column was proposed rule, and the other column was final rule. So the sense I got was that this is now law.
Correct. So you're right. I did see earlier, now that I am remembering, that what we're talking about now was the simplified, less intense version of what the original proposal was. So you're 100% correct. So that must mean that it's final. Yeah.
All right. So let's see what happens. And once you hear back from your attorneys, with all the usual CYAs that we don't give legal advice and blah blah blah, maybe you can remind us what the impact is, if it is significant.
Talk to your attorneys and your accountants. That's all I'll say.
Well, that's right. I mean, I have this golden rule. I tell people, AAA. That's my golden rule. Ask an accountant if it has anything to do with tax, or ask an attorney if it's got anything to do with law. That's what
I did immediately. So.
That's right. Well, that's what we learn. Going into 2024. I love that Warren Zevon song. All we need is lawyers, guns, and money. Right. Who the heck knows? Anyway, on to our favorite topic. It's one that you and I kind of been talking about. How do we get off this topic? But let's take some slightly deeper dives onto specific aspects of it. And that is the multifamily roller coaster. And so I'm going to read, I'm trying to paraphrase these. I've actually got quite a lot here, so I'll try and keep it brief. But the Real Deal, they had an article this week. When will Texas multifamily roller coaster ride end? Developers, investors, and lenders navigate frozen capital markets and explosive growth. Now, it's a couple interesting points here. So I'm going to read this, and then we can talk about Texas in particular.
Yeah.
The slowdown in rent growth, quote, behind the slowdown in rents is an influx of supply. Each metro area in Texas is expecting huge increases to its apartment stock as units come online in the next 18 months. Dallas-Fort Worth expecting, get these numbers, 73,000 new units, the most of any American city. Austin's going to get 46,000, Houston 39,000, San Antonio 17,000. However, I shall continue on this point, but this is freezing up as capital markets dry up. Quote, that leaves an opening for those who can break ground in the coming months, according to Roberto Casas, a multifamily investment executive with JLL. If you can figure out a way to get a development deal capitalized today, you're going to be delivering into a market with very little supply, not a lot of competition, and probably very strong operational fundamentals. He also, the JLL, this was a Real Deal, pricing is settling between, it's exactly what you said, 20 and 25% down for multifamily compared to 21 and 22 pricing. What do you have to say about?
Number one, that was a blast from the past, because 15 years ago when I worked at CIM Group, I believe we worked with Roberto on a Dallas deal. So I'm glad to see that he's still in the market. And now he's getting quoted. He must have been pretty young back in the day. Well, yeah, I was just looking at some of these stats as well before I even knew we were going to talk about this. The big metric to look at, yes, the number of units is the most important thing, but what's really shocking to me is what percentage of the market size that is. So Austin, if I have my numbers correctly from a couple of days ago, 15%, something like that, of Austin's apartment market size. So you take the number of units under construction and divide it by the number of units in the market. It was somewhere around 15%. I mean, that's just wild.
Yeah.
I think Nashville, by the way, is 15%. So yeah, you always have to put it in that context. Dallas is a huge market. Another thing we always used to do back from even my office days working for Sam Zell is, nothing's ever going to stop Texas developers from wanting to build another building. And so there'll always be new supply. I think an important point, though, is yes, all this new construction is coming in, but it's still not addressing housing shortage in kind of that mid-workforce housing area. So for folks that are operating and buying 1980s buildings or 1990s buildings or even 2000s buildings, no new supply is coming in there. So there are different supply and demand dynamics, I guess, in the different market segments. Then I'll pause there to see your commentary on this.
Right, because then the first signs of stress that you do see in existing stock are concessions. You start seeing concessions. I remember seeing this retroactive. So I do hope I said, well, we want to stay off multifamily books. I'm going to start saying the same thing again and again. But I do remember retroactively realizing when I was first in Southern California doing ground up in the run up to the savings and loan crisis, was suddenly seeing 2 months free rent signs and not really internalizing what that meant on all new construction. As I drove around San Diego in the day, this was in the late 1980s. But it wasn't until afterwards that I realized that was because I was very young and didn't think, I thought this time was different, of course, as you do your first time around. Didn't realize that was a sign of a softening market. But the news in Texas, not just Texas, is it? There's this news, and this is in your backyard here. An article also in The Real Deal. Veritas has troubled loans in San Francisco. Is LA next? That's their headlines. Apartment landlord faces rising rate pain on debt tied to 11 buildings in Southern California. Quote, San Francisco-based Veritas is not making enough income from 11 of its apartment complexes in Los Angeles County to meet its monthly debt payments as rising interest rates have ballooned debt costs, according to Morningstar data. What do you know about the Veritas deal over there?
Yeah, no. So they became quickly. I know the founder. I see him around town. They accumulated thousands and thousands of rent-controlled San Francisco apartments during a great time. He made a huge bet, a lot of guts on that. Did very well. Made a good amount of money. Still owns a lot of the units in both San Francisco and LA. He specializes in rent control apartments. So because San Francisco, these older buildings, and in LA, rent controlled, what you're gonna have is if people are staying put in rent controlled apartments at their below market rents. We're seeing this in some of our smaller Silicon Valley buildings that are rent controlled. The way you make money in rent controlled apartments is those folks leave, they move out, and then you renovate the unit, put a lot of money into it, and then you lease it up for hire. But what started happening in the pandemic, whether it's Veritas or some other folks, is you didn't see that turnover. If you had floating rate debt, that's going to increase your obviously your debt payments. Rents are softening. Not a good situation for cash flow. So you've got to figure out a way to hold on until LA and San Francisco recovers, and you can get the return over that you probably projected in your pro forma. So it's kind of a meeting of all sorts of different bad things happening. Tough situation.
So let's drill down on this a little bit from a banking perspective. So how do you deal with this rising interest rate, excessive debt, etc.? And Veritas spokesman says, apparently, according to The Real Deal, we intend to extend the loans. And we've talked about this, right? The banks are being encouraged to extend. And we won't go into exactly what that means, essentially. But extension, even from a bank's perspective, only works as long as DSCRs remain positive. DSCRs standing for debt service coverage ratio, or DCR, debt coverage ratios. And so if it is negative, in other words, if there isn't enough cash to support an extension on a loan, so even if the value, even if the loan to value ratio is higher than a bank would normally want, the bank will look to extend the loan and to keep it going. But they have to see positive cash flow. There has to be more than 100% of the debt service in cash flow for them to be able to do that and not see a non-performing loan.
Yeah, I mean, what you're having here, particularly in San Francisco, rent control is your LTVs, your loan to values are now sky high in many of these buildings, which is not a great thing. And then to your point, they're all underwater. So from a cash flow perspective, so you're not able to bring in enough rent minus expenses minus capital expenditures to cover the debt. What you're also seeing, which is multiple different things happening here. So groups like Veritas are trying a number of different things, selling some of it to free up cash, extend the loans, find preferred equity. I mean, there's a lot of different solutions across a number of these buildings, but it's really, really challenging. And I believe in the future of San Francisco, but as the lender really willing to be able to work with you and want to work with you for the number of years that it's going to take, maybe not, probably depends on the building.
Well, the reason that I was particularly interested in bringing this point up is that there is another approach to reducing your debt without actually having to do a cash in refi. So I'm going to read this to you. And this is something that I have seen from my inside banks and various other things as well. We're starting to see it with more frequency across the market's interest. I'm going to read this as well. In January, this is also Veritas related. The landlord defaulted on $1 billion in loans tied to 95%. Tied to 95 rent control properties in San Francisco. Currently, the firm is awaiting the results of a debt auction for loans backed by a total of 2,452 units in two portfolios. As TRD reported in May, Veritas planned to bring new financial partners to buy back its own debt. What does that mean? Buy back that defaulted debt at a discount. Oh my goodness! What an approach!
Yes, I heard I've heard in the market that deal is that they've picked somebody there to do that, and that Veritas, I think, as it even says in the article, would be interested in bidding. It's so interesting
for its own debt,
bidding on the distressed debt of their own building so that they can right size their basis effectively. It's smart if you have the capital to do that. So I think we're waiting to see the winner of that, whether or not they successfully did that, or if another one of the major players in San Francisco, and there's others, won that deal. But it was a massive portfolio, as you said. I mean, massive number of units.
Right. Yeah.
You're really getting a big piece of the San Francisco apartment stock with a deal like that.
But this tactic to throw your own debt into default so that a bank is forced to sell it, to either sell the loan or to take it back and then sell the REO and then to buy it back in. I've seen this. I wouldn't say that I've seen it as a conscious, I've not seen it overtly used as a conscious tactic, but I'm pretty sure that some of the instances I have seen, it has been a conscious, all right, how are we going to resolve this excessive debt problem? Let's force the bank to sell the note and buy it back. The challenge with doing that, as in inverted commas, clever as it might be, is that you are wiping out one set of partners, equity partners, and you have to bring in a new set. So how do you balance that? How do you deal with that?
This is what we were talking about earlier in the call, is you can make a lot of money in this, and it's incredibly complex. You have to know what you're doing. Someone's going to lose. And Peng is an incredibly smart guy, really smart investor. Probably has a lot of different investors, institutional partners. I mean, what do you do there? I mean, I guess he's probably looking out for the best. There's no good answer. I'd love to tell you there's a good answer. Someone's going to be upset, pissed off. So I don't know enough and can't comment enough on who their exact investors are and how he's thinking.
I'm not specific. Yeah. Well, let me just interrupt you briefly there, because I'm not suggesting that is this circumstance. I'm just talking about in general, as the market starts to kind of take this slow decline with all the extensions that there are, that banks are inclined to give and being encouraged to give by regulators, that some sponsors will find this potentially as a way of reducing their own debt, is to throw it into default, then buy it back. Let's finish off. Go ahead, Dave. Yeah.
Wait, one last little thing is that the other thing, just hearing in the market is some of those loans on those buildings had a multi-million-dollar what's called interest rate cap was another option to cap the floating interest rates from going up. And then you're trying to make the decision, do I have the cash to spend tens of millions of dollars on an interest rate cap, or do you go the other route? So my guess is he was looking strategically at all these different options and trying to figure out what was the best for his company and his investors.
And so let's wrap up with this. I was going to wrap up with a story about how high a rate can housing take, and the answer apparently is 8%. So we'll just short circuit that comment. But you sent me this email right before we started here about NEMA, the NEMA San Francisco Tower. So Globe Street had an article, the loan default imminent on $384 million loan for NEMA San Francisco Tower. The loan, which is backed by 754-unit luxury multifamily, transfers to special service. And one very quick quote from that article, which speaks directly to DSCR and loan coverage. The luxury apartment complex has been struggling to fill vacancies. Miami-based Crescent Heights has stated in writing the property's cash flow no longer can cover the monthly debt service. What do you know about NEMA? That's right around the corner from you, isn't it?
Yeah, absolutely. I mean, so just real quick, NEMA is right by where Twitter's headquarters still is, where Uber's and Square was. They may still have some space in that building. That was the area of San Francisco called Mid-Market, where the late Mayor Lee provided a lot of tax credits to revitalize that area by encouraging tech companies to go there. A lot of money was made in that area. It was really fixed up. NEMA is an ultra luxury project where you could just kind of roll out of your Twitter office and roll into bed at a really luxury, but it's a dicey area and always has been. So when the pandemic hit, that area that's the area, unfortunately, that all of you are probably seeing on the news where there's a lot of issues going on. That is this location.
That's right there by that Market Street. What was it? 1128 Market that we were talking about.
Yeah, it's right by the open air, quote unquote, open air drug market area. It's right by 5 blocks from, which is not far in San Francisco, from the Westfield Mall that has been struggling. So me personally, I was always fascinated by this building because I'm given the issues, I'm so surprised that it's taken this long, because I was getting ads when I was on the internet during the pandemic for, I think at one point I was seeing ads for 3 or 4 months free, which I'd never seen before. At one point, there was a story about how they were going to try and do corporate leases for a lot of the units. That wasn't working. So this does not surprise me, given all the factors that they've been facing. It's an impossible situation.
Dave, let's wrap up with that today, and we'll just see how things roll out. Thank you so much for joining me. Thank you, dear viewers, for joining both Dave Saxe and me today. I'm always trying to get my grammar right. Is it me or is it I? It is me. Thanks for joining me today and Dave Saxe. If you'd like to learn more about Dave and Calvera Partners, or about real estate syndication crowdfunding in general, go to the gowercrowd.com website. While you're there, sign up to our newsletter. It's totally free. It goes out every Wednesday, and you can always unsubscribe. Dave, it's always a pleasure to see you. Thanks so much. And we'll all be well. We'll see you next week for another episode of the Real Estate Reality Show news update. For now, this is Adam Gower and
Dave Saxe.
Wishing you well for the weekend and signing off. I always find a hard time to click this bloody thing. There we go.